Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. On Thursday, March 5th, 2026, the market tried to trade like everything was fine. But it moved like it was bracing for an oil-driven inflation surprise. Headlines around the Iran conflict shoved energy right back into the story, and you could feel traders going defensive by liquidity, not by textbook sectors. The Dow took the punch. The S&P 500 and the Nasdaq didn't really win. They just didn't crack, because late-day buyers leaned on a small set of mega-cap tech pillars. So yeah, the close looked contained on the surface, but the tone was cautious, and the real tell was underneath. Participation narrowed, and selling pressure owned most of the middle of the day, until a relief bid finally stopped the bleeding late. Now flip to the S&P 500 Heatmap. This wasn't a clean washout. It was a messy red-tilted board, with a few bright green boxes doing outsized work. The classic generals versus troops effect. Microsoft and Amazon were visible support pillars, while Apple, Google, and Meta weighed on the other side. And the ugliest clusters weren't in exotic corners of the market. They were in places traders usually trust, consumer staples like Walmart, Costco, and Procter & Gamble, plus industrials like GE and Caterpillar. And that mix matters, because it says the index was held up by concentration, not broad participation. And that brings us to the rotation. It did not feel like a clean risk-off playbook. Energy was the straightforward winner, crude anxiety was all over the screen, and energy caught steady bids. But the real surprise was what didn't work. Staples, healthcare, and utilities were broadly weak, so instead of hiding in classic defensives, traders crowded into two spots the tape still rewarded: energy exposure and a very selective slice of mega-cap tech. Meanwhile, industrials and other cyclical names got hit hard. That's not calm confidence, that's positioning triage. The tension underneath the whole day was simple. Oil pushed inflation risk higher, while the market still wanted to believe in easier policy later. Price action mostly postponed the argument. Selling pressure dominated the middle of the day, then a late-hour relief bid made the indices look less dramatic. But it did not change the character of the session. So, the takeaway is subtle but important. Risk didn't shut off everywhere, it narrowed. The market walked away from the day feeling supported, just not healthy. One pocket of chatter to flag strictly as chatter was CRCL. It's been tied to recent analyst buzz, price target talk, and momentum-style mentions over a multi-day window into March 4th. But the move specific to today's session wasn't fully confirmed in our notes, so treat it for what it is: a sentiment gauge some traders watch when liquidity goes looking for a story, nothing more, and definitely not a fact pattern to trade blindly. Another powerful force is quietly shaping consumer psychology right now: artificial intelligence. On paper, the economy looks strong. Unemployment is low, companies are profitable, and tech giants are pouring hundreds of billions of dollars into AI infrastructure. But surveys are flashing something striking. High-income professionals now think there's roughly a 20 to 25% chance they could lose their job in the next 5 years. That level of anxiety usually shows up in recessions, not during record stock markets. So why the disconnect? Because AI is moving far faster than previous tech revolutions. Economists sometimes compare inflation to the tortoise: slow and predictable. Artificial intelligence is the hare. Companies are rapidly automating tasks, restructuring teams, and swapping expensive labor for software and algorithms. The productivity gains could be enormous. But during the transition, the benefits likely hit capital and shareholders first, while workers sit with the uncertainty. And that tension may become one of the defining economic stories of this decade. The U.S. economy is increasingly taking on what economists call a K-shaped recovery, where different groups move in opposite directions. At the top of the K, asset owners are thriving. The S&P 500 is still hovering near record highs, powered by AI spending, massive data center investment, and the dominance of mega-cap tech. But on the other side, consumer sentiment is deeply depressed. University of Michigan surveys show confidence still near recession territory, even though unemployment is around 4%. Historically, a very strong labor market, and what's unusual is this: higher-income households are pessimistic too. Their sentiment readings now look a lot like periods that lined up with major market stress. Part of the reason is simple: prices never went back down. Even if inflation cools, the overall cost of living stayed permanently higher. So the stock market may look strong on the surface, but underneath, the lived economic experience for a lot of households tells a very different story. Broadcom, AVGO, was the cleanest green box on the screen, up about 4.8%, and it mattered because the tape was otherwise choppy and red-tilted. The move was tied to an earnings-driven AI narrative, with guidance and buyback enthusiasm dominating the chatter. On a day when macro pressure was loud, this was a reminder that company-specific AI winners can still attract real bids. And that's the key. It wasn't all semis, it was AVGO. Microsoft MSFT finished up about 1.3%, and it played a very specific role today. It helped stabilize the indices while breadth deteriorated. This is that classic defensive tech behavior. When traders don't trust the tape, they concentrate into liquid pillars they think can absorb volatility. MSFT being bid didn't mean risk was back. It meant the market was trying to keep the sell-off contained. Amazon, AMZN, up just under 1%, was another example of the market choosing a few liquid leaders instead of buying the whole tape. It gave selective consumer discretionary and megacap support into the close, helping offset weakness elsewhere in the megacap complex. The implication is straightforward. The bid was real, but it was narrow. Walmart, WMT, dropped about 3.5%, and it's hard to overstate what that signals on a day like this. WMT usually sits in the defensive bellwether bucket, but it still got hit hard alongside broader staples weakness, with pressure tied to forward outlook sensitivity and ongoing guidance skepticism in the name. When the market sells a name like this, it reinforces the day's character: selective liquidation, not a clean rush into safety. Caterpillar, CAT, fell just over 4% and was one of the biggest drags on the Dow. Here's why that mattered. CAT is a global growth and capital spending barometer, so heavy selling here reads as macro fear, not just stock-specific noise. In a session already dominated by inflation anxiety and de-risking, CAT's move underlined how aggressively the market hit cyclicals. ExxonMobil, XOM, was up about 0.2%. Not a huge move, but it sat right on the cleanest theme of the day. Energy stayed bid as crude rallied on Middle East and Iran conflict-driven supply risk fears, and that strength mattered because it reinforced the inflation risk that complicates any simple Fed will cut narrative. If you wanted one sector tell from the session, it was energy acting like the market's hedge. Near term, the market setup stays simple and touchy. First, traders are still hypersensitive to energy and inflation headlines tied to the Iran conflict narrative. That's the tug-of-war. Oil-driven inflation risk versus expectations for Fed cuts. Second, next week delivers a heavy macro cluster. Wednesday, March 11th at 8:30 a.m. Eastern is CPI and core CPI. Thursday, March 12th brings initial jobless claims, and Friday, March 13th is packed. Core PCE, preliminary GDP, durable goods, JOLTS job openings, plus University of Michigan sentiment and inflation expectations. Heading into that calendar, watch whether leadership broadens or keeps narrowing into just a few names. So the close didn't give us a crash, but it did send a message. The Dow's pain, the Heatmap's red tilt, and defensives getting sold alongside cyclicals all point to a market managing risk through concentration, not confidence. If we get another headline jolt, watch the same pressure points. Does energy stay bid, and do the megacap stabilizers keep absorbing the tape, or does that narrowing finally snap? That's the handoff into the next session. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.